Hi, I'm Giuseppe Incarnato, Chairman and CEO IGI Investimenti Group. Welcome to Private Equity Lesson 3944. The financing of private equity companies cannot be separated from collecting the necessary funds to realize the investments. The fundraising activity is fundamental within the managerial process regardless the legal status of the deal, the organizational structure of subjects involved, and the characteristics of firms or projects selected later. Typically, as already seen previously, there are two broad categories of investors, individuals and institutional investors. Individuals are ordinary savers who have a remarkable number of resources available for investments, the propensity and the preference for high-risk investments, the desire for portfolio diversification, and the objective of achieving high returns. However, individual investors typically invest significantly less than institutional investors. Institutional investors, known also as professional investors, have a deep knowledge of the market environment and they are able to accurately understand the risks and expected return of an investment or financing project. Generally, institutional investors have more resources to invest and operate in the medium/long term, as they can ensure private equity firms or venture capitalists a substantial flow of resources and are able to wait a reasonable period of time to achieve their performance targets. As we have already seen, these two categories of investors have the role of limited partners, LPs. Investors in private equity firms deal with different types of risk. Business risk is borne by private equity operators, as they are in charge of identifying the opportunities and, thanks to the resources committed by LPs, they are able to exploit economies of scale. The limited partners face information asymmetry and the risk of opportunistic behavior by financial institutions. Financial institutions, at least in theory, face the risk of opportunistic behavior by suppliers of funds that cannot face the agreed payments. An appropriate contract structure can overcome these difficulties, despite they cannot be entirely eliminated. The information asymmetry occurs because the investors have trouble monitoring the private equity firms. Instead, moral hazard is generated from the private equity firms, who generally subscribe up to 1% of the capital with the aim of maximizing their gain and at the same time to diversify the risk. To reduce moral hazard and information asymmetry and to ensure a high rate of success, fundraising has to be deeply studied and structured as a selling game where reputation, mutual trust and love for gambling are the pillars of a risky job dedicated to the raising of large amounts of money. Appropriate early-stage design and planning of a fund is of paramount importance for the fundraising phase to be successful and for the firm to start to operate. An advanced planning can be helpful to focus the fundraising team, so that effort and costs are not expended inappropriately. They all aim at making the best out of the promotional activity that will be realized by the private equity firm to reach out the largest number of investors in the shortest time possible. The stronger the trust in the reputation and in the track record of the private equity firm, the shorter the fundraising period. To sum up, there are several activities that should be encompassed and planned carefully before the fundraising even begins. Among the preliminary activities, allocating costs is surely the most important one. Costs include the out-of-pocket costs that general partners, GPs, will bear to promote the fundraising activity, especially if this activity is carried out on an international level. Moreover, during budgeting activity, it is important to include legal and regulatory charges. It is important that GPs review any potential restrictions from existing funds or contracts on raising new money and verify the availability of the GP's human and financial resources, in order to market and raise the fund. Before starting planning fundraising, GPs should define the positioning of the fund. A fund strategy and positioning depend on the following two variables: the equity stake that the private equity firm aims to have in the portfolio companies. The stake can be either a majority or minority one. It generally depends on the investment cluster, and on whether the GPs want to have a hands-on or a hands-off approach. The industry specialization: there are firms that have specialized teams in specific sectors, in order to provide the best assistance possible to the entrepreneur and in order to achieve a deep understanding of the market. Thanks to these two variables, it is possible to classify funds in 4 different types depending on their objectives. In most venture capital deals, GPs are industry-oriented, in light of the high technological content involved in many startups' products. Growth funds have the purpose of expanding companies that typically already have a strong customer base. They also can hold either a minority or a majority stake. Depending on the private equity firm, they can be specialized by industry or not. Finally, generalist or balanced funds do not have a specific industrial or degree of control orientation. Once the target cluster is recognized, it is necessary to identify the human resources that are needed to implement the fund's objectives and to responsibly manage and administer the fund. Before undertaking the fundraising and all other promotional activities, it is important to forecast the fund's cash flows, including the level of management fees, the provisions regarding transaction, advisory or other costs to be incurred by the fund, and the appropriate profit share and carried interest structure. The level of management fees and target carried interest has to be consistent with the fund's objectives illustrated above. Depending on the geographical scope of the fund, it is crucial that GPs plan its form and jurisdiction as well as key structural terms, such as the length of the investment period in terms of the fund, minimum and maximum fund sizes, and deal flow allocation between other funds managed by the GP. Nowadays, it is also relevant to consider including responsible investments, such as the ones classified as environmental, social, and governance, ESG. The first step of the fundraising activity is the creation of the business idea. It starts by explaining the idea to the business community and catch the attention of potential investors. Business idea creation is aimed at producing an information memorandum to be promoted in the market. Before that, a preliminary phase, often called taste of waters, occur. This is carried on in a very informal way among the professional network, with the aim to assess, for instance, whether it makes sense for the private equity investors to invest in a specific private equity cluster or not. After managers have received an informal consensus about their activity, a more formal part begins, and the information memorandum is produced. The information memorandum has the objective of explaining the rationale of the business idea to the business community and has to appeal to the potential audience of investors. The success of the business idea is strongly related to the reputation and to the track record of the private equity firm. Some of the main information contained within the document are the following: choice of the vehicle, target to invest, corporate governance rules, usage and size of leverage, etc. In United Kingdom and United States, private equity investors are generally structured as a single company that simultaneously manages different funds that are legally separated in a limited partnership. The typical European structure for private equity activity is the closed-end fund. Like in the case of LPs, it is impossible to commit further capital after the fund has been launched, and the investor exit is possible only when the fund expires or by agreement. Structured, well-planned, and exhaustive communication helps the temporary marriage among the investors. It is executed though the investment plan realized at least annually and within 6 months after the end of the fiscal year and through the quarterly performance report, which includes fund summary describing the structure strategy and relevant news, executive summary detailing funds, investments, and changes related to fund managers, the trend of a monthly IRR and the actual value of the sum invested, important news about the target companies. As already stated in the previous chapter, many funds rely on an advisory board and an investors committee. The advisory board solves potential conflicts of interest and supports the managers, whereas the investors committee takes care of the relationship with the key investors. It is advantageous to avoid an excess of involvement in the daily operations without the delegation of audit and planning authority. Therefore, it is impossible to conclude the analysis of the first fundraising step without considering the costs connected with the creation of the deal in terms of time spent, economic resources, and due diligence. Preparation of the business idea involves a legal audit of the fund structure and the predisposition of a marketing presentation. The most expensive part of building a new private equity fund is driven by the costs of legal and fiscal advisors. In addition, a private equity firm needs also to take into account additional costs due to promotion fees paid to the placement agent. The placement agent is a specialized operator with a big network of potential capital-raising clients whose experience contributes to the definition of the fund and the marketing strategy. Therefore, the GP hires the placement agent to facilitate a quick fundraising process and attract a more effective segment of investors. The placement agent is paid a significant commission, about 2% of capital raised, applied only in case of success. In Europe it is common to form a sponsorship with banks and consulting companies with well-known and extensive reputations. Sponsors of the fund are selected because of their professional track record and success with previous deals. It is also important to underline the importance of investment managers who manage and maintain the relationship with the potential investors. They organize several periodic meetings to inform the potential investors about the fund. GP must also manage and develop a relationship with financial markets. This element is of paramount importance for the entrance and maintenance of the fund's position inside the financial market and for the future successful fundraising. The due diligence process allows investors to acquire all the necessary information to make the investment and guarantee fast closing. When due diligence is done properly, it focuses on the market environment, financial structure, and legal and tax position of the company financed. We can identify the second step of fundraising activity with the name, job selling, in which it is crucial to identify the category of investors potentially interested in a fund. The fundraising strategy is profoundly influenced if the fund is new, or if it represents the continuation of a previous initiative. The absence of a track record and the necessity to develop a network of contacts makes the fundraising complex and laborious. After deciding the channel and the parties to be employed to raise funds, the following step is to identify the target market and develop the fundraising strategy. To raise funds, domestic investors should be consulted first, as their confidence in a specific fund attracts foreign capital, who take into account the economic prospects of the fund's country, its capital markets, the presence of interesting entrepreneurial initiatives, etc. The size of the fund becomes conspicuous if large institutional investors are involved. When selecting potential clients, it is also necessary to note the increasing role played by gatekeepers, institutional investors offering consulting management or services. Originating in the United States, but now diffused also in Europe, gatekeepers raise funds from small or medium-sized institutions, large institutions without experts in the private equity sector, or high-net-worth individuals who wish to invest in private equity initiatives. The pre-marketing phase focuses on understanding the potential market in order to evaluate interest and gather useful information for the investment proposal. This usually occurs through meetings to update existing investors about new possible initiatives. A purely informative meeting such as an international roadshow will be organized with new potential investors. Managers must be prepared to give precise information relating to the track record of past initiatives, specifying details relative to the structure of the operation, cash flow generation, the growth of the investments, and timing of exit. Once the fund has market approval, its structure must be defined in cooperation with legal and fiscal advisors. The project must remove any legal, fiscal, and technical factors that could discourage investors. To conclude this step, the private equity firm needs to prepare and send the legal documentation to the probable adhering investors, partnerships agreements, copy of contract, fiscal and legal matters, etc. The operation will be closed once the final adherents are notified. In the case of leveraged buyouts, a crucial aspect on which to focus on the fundraising phase is the financial structure of the private equity deal, as the profitability of the investment is strictly connected to the value created by debt leverage. The optimal capital structure is a range of D/E that ensures tax shield benefits and avoids any risk connected with distressed financial structure. Debt can be divided into different categories depending on two main elements, seniority and operational issue financed. Senior debt is the main part of the debt in a private equity deal that ensures the investor will be repaid before any other creditor. If senior debt does not cover the entire acquisition price or the promoter wants to reduce the level of equity, it is possible to be financed with junior debt, which has a lower level of guarantee but higher level of interest. If these debts are traded on a public market, without collateral, they are called high-yield bonds. This category of debt will be settled only after the total repayment of the senior facilities. Halfway between equity and debt is mezzanine debt. This is a sophisticated financing instrument, which is covered by the same senior collateral, and its reimbursement always happens between the senior and the junior debts. The servicing of mezzanine debt is broken down into three different types: interest paid yearly, structured with a capitalization system with payment at the end of the loan, and represented by equity linked to company performance. The point of arrival of the fundraising phase is represented by closing. This phase can be meant in two ways. A successful closing occurs when the private equity firm is able to collect all the money necessary to begin the activity. A successful closing can occur, and this was possible thanks to the reputation and to the purpose of the initiative. A pure closing occurs when the PE firm is not able to collect the whole money in the fundraising phase. Such is the case when the managers of the fund do not have a very robust network. Despite having stated, in the limited partnership agreement, the target timing after which the private equity will start to operate, some funds have the so-called first close. This means that whenever a certain threshold of funds has been raised, managers can begin scouting companies and making investments. However, they still leave the funds open for further LPs for a limited period until they reach the final closing date.